What's going on? This is your man Big Stu, Scott Stewart or Professor Stewart, depending on how you know me. Welcome to Stock Market Basics, at least a billion, as sponsored by Genius Lab. We're going to get right into it today. We got the basics. I'm going to give you like 9 to 12 different vocabulary words, the basics to get you into a room, to have a valid conversation, to let people know that you have a working knowledge of how the stock market works. Let's get into it right now. So when we're talking about investing, I'm just gonna now mind you, these are just the basics. So if you're a little more advanced and you see, he should be, these are just the basics. I'm talking to my newbies out here. When we talk about your portfolio, it could be your IRA, your mutual funds, your certificates of deposits, your bonds, right? It could even be your real estate holdings. It's whatever proof of ownership that you have in some sort of security, right? And the security is a safe place to put your money and allow it to grow at the same time. When we talk about a stock, we're talking specifically about the ownership in a company. Today, you don't have to buy a whole stock. You can actually buy what's called a fractional share, a piece of a share, right? So you can still own less than a whole share and be considered legally an owner of the company, a stockholder. Stockholder, shareholder, those terms are used interchangeably. When we talk about risk, we're talking about your risk tolerance, your willingness to lose or to win. Remember this: bet big, win big. But also, if you bet big, you stand the chance of losing big. Conversely, bet small, lose small, right? So you bet a little, you lose a little, but you don't stand a chance of winning a lot because you're only betting a little. Now, when we talk about diversification, or anytime you see a word that starts with DIV, you know we're going to be talking about dividing something up. In this case, when we're talking about diversification, we're not just talking about the number of stocks you own. That's not it. We're talking about the number of different industries that you are invested in. The more industries that you're invested in will help mitigate against some of that risk for losing your investments. Now, you do not have to diversify your investments in order for you to make money. It is simply a strategy, a diversification strategy to help ward off against loss. Not everybody diversifies their portfolios. Some investors are super savvy by being laser-like focused on a particular industry, which makes their portfolios, their stock portfolios, less diverse than others. This is going to be totally up to you. Now, if you are interested in diversifying and minimizing your risk, you might want to think about getting into some mutual funds. And mutual funds are simply this: a bunch of different companies from various industries wrapped in one investment, right? So they don't call that investment a stock because a stock is one company. A mutual fund is a bunch of different companies that could fund the profit of your investment, and they have a mutual relationship of all being in the same place to serve the same purpose. That's your mutual fund. Many times in a mutual fund, you'll find 80, 90, 300 companies could be wrapped into one fund to serve as a diversified investment for you. Not all companies pay dividends. Let me say it again. Not all companies pay dividends. A dividend is a share of the profits that goes to stockholders multiple times a year. Sometimes it's quarterly, sometimes it's, annually, sometimes it's semi-annually, whatever the case may be. Dividend payments are determined at the annual meeting. That's when they determine what rate they will pay and how often they will pay stockholders a dividend payment. Actually, companies that have dividends are also known as income stocks, because regardless of how the stock performs, if it is a stock that pays a dividend, you will always get a piece of the profits. Where do you go to buy these stocks? You go to the NASDAQ, the NYSE, or the Amex. The NASDAQ, the National Association of Securities Dealers and Automated Quotations. The NYSE is the New York Stock Exchange, and the Amex is the American Stock Exchange or the American Exchange. But you don't just walk in there like you're walking in your local grocery store to buy stocks. Large investment companies like brokerage houses, they handle the transactions or the trades of folks like you and I, right? The consumer, right? And so the NYSE, the NASDAQ, and the Amex are the only places where publicly traded companies can exchange their stocks, okay? If you are a privately owned company, that means you have not initiated an initial public offering, which means you are not a publicly traded company. People might still be able to buy stock in your company. They just can't buy it in the open market, which would be in America anyway. The NASDAQ, the Amex, or the New York Stock Exchange. A public company can accept money from the general public by having people trade stocks, trade or exchange stocks in exchange for cash. It's a great way to raise money. If you are a public company, your company is traded on one of those three exchanges, and anyone in the general public who is capable can buy stock in your company. If you're a private company, people can buy stock in your company if you are incorporated, right? But they just can't go to one of these three exchanges to do it. Two measurements of how the economy is doing, just for basics, are the Dow Jones and the S&P 500. The Dow Jones, also known as the Dow, the DJIA, the Dow 30, the Dow Jones 30, measures 30 of the largest publicly traded companies in America. Companies like 3M, United, Nike, Apple, and McDonald's, and I can go on and on. The S&P 500, the Standard & Poor's 500, measures 500 of the largest publicly traded companies in America, including the Dow 30. Okay? Now, why do we need to care about the Dow Jones 30 or the Dow 30 and the S&P 500? Because depending on how those two indices, plural for index, indices are doing, is a great determination for how the American economy is doing. Okay, so you want to keep a pulse on how those indices are fluctuating so you can have an idea of how consumers are feeling about the economy. Bull markets and bear markets, right? This is really interesting. If you're in a bull market, that generally means stock prices are rising. If you are a shareholder, a stockholder in a bull market, your portfolio is increasing in value. In a bear market, it's just the opposite. Stock prices are falling. If you are a stockholder in a bear market, it doesn't mean that you need to sell all of your assets. You may want to consider buying the dip. It's something that we'll talk about in a later lesson. So keep that in mind. The best time to invest in stocks is during a bear run. Let me say this again. The best time to invest in stocks is during a bear run. You want to buy stocks when they are low. So bear markets are when stock prices are falling. Great time to buy. Stay away from buying or investing during a bull market. But if you're already a stockholder, a shareholder, that's a great rally for you. And finally, market capitalization. Market capitalization, also known as market cap, is simply how valuable is the company. And there's a simple formula to figure that out. Multiply the current stock price by the number of outstanding shares, and it will tell you exactly how much the company is worth. Taking a look at Tesla, it shows the market cap, the value of the company, is $728 billion. $728 billion, 37 million. And the current stock price is $735.72. Now, you are in tune with the basics of investing. You are ready for conversations. Go back and review this video. Take it to heart. Look it up. Challenge it. If you have questions, give us a call. Check us out. Go to geniuslabchicago.com. Post your questions. Let us know what you're thinking. And we look forward to seeing you really, really soon in our next lessons. Until next time, you already know what it is. Peace.